This conversation is powered by Google Illuminate. Check out illuminate.google.com for more. Today's discussion centers on Section 10 of the Federal Reserve Act, specifically the Board of Governors. It's a crucial piece of legislation shaping our nation's monetary policy. What immediately strikes you about this section's structure and importance?
The meticulous detail regarding appointments, qualifications, and responsibilities highlights the gravity of the board's role. The 14-year terms, staggered to prevent wholesale changes, ensure continuity and institutional knowledge.
Precisely. That stability is vital. But the Act also speaks of fair representation of financial, agricultural, industrial, and commercial interests. How does the board balance these diverse perspectives?
It's a constant balancing act. The selection process aims for geographical diversity and representation across economic sectors, ensuring a broad understanding of the nation's economic landscape.
And what about the recent amendment mandating at least one member with community banking experience? What impact does that have?
That's a significant addition, reflecting a growing awareness of the needs and challenges faced by smaller banks. It brings a crucial perspective to the table, ensuring the board's policies consider the impact on all financial institutions.
Let's delve into the appointment process itself. The president appoints with Senate confirmation, but the Act emphasizes due regard to a fair representation. How does this play out in practice?
It's a complex political process. The president considers expertise, regional balance, and political affiliations. Senate confirmation adds another layer of scrutiny, ensuring nominees meet high standards of competence and integrity.
The Act also specifies that board members must devote their entire time to the board's business. Why is this full-time commitment so crucial?
The complexity of monetary policy demands complete dedication. Members need to stay abreast of economic developments, analyze data, and participate in extensive deliberations. A part-time commitment wouldn't suffice.
And the ineligibility to hold office in a member bank after their term, what's the rationale behind that?
It's a crucial conflict of interest safeguard. Preventing post-service employment in member banks ensures impartiality and prevents undue influence on policy decisions.
The 14-year terms are designed to provide long-term perspective. How does this contribute to effective policymaking?
Long terms foster institutional memory and reduce the influence of short-term political cycles. It allows for a more considered approach to policy, avoiding knee-jerk reactions to immediate pressures.
The designation of a chairman and vice chairman for 4-year terms introduces a layer of executive leadership. How does this structure function?
The chairman provides leadership and direction, while the vice chairman share responsibilities and offer support. The recent addition of a vice chairman for supervision underscores the growing importance of regulatory oversight.
The Act also addresses vacancies. How does the process ensure continuity even during unexpected changes?
The president can fill vacancies during Senate recesses with temporary appointments, ensuring the board remains fully functional until permanent replacements are confirmed.
The board's funding mechanism is interesting. It levies assessments on Federal Reserve banks. Why this approach instead of direct government funding?
This approach emphasizes the board's independence from direct government control. While the government ultimately oversees the Federal Reserve System, this funding method helps maintain operational autonomy.
The Act also grants the board authority to acquire and maintain its own buildings. What's the significance of this provision?
It ensures the board has suitable facilities to conduct its operations effectively. This independence from reliance on government-provided space further reinforces its operational autonomy.
The prohibition on board members holding stock in banks or serving as officers is a clear statement about maintaining independence. How important is this?
It's paramount. This provision prevents conflicts of interest and ensures the board's decisions are driven solely by the best interests of the nation's monetary and financial system.
The board's responsibilities extend beyond just monetary policy. The Act mentions various reports and appearances before Congress. Why is this accountability crucial?
Transparency and accountability are essential for a body with such significant influence on the economy. Regular reporting and congressional oversight ensure the board's actions are subject to public scrutiny.
The annual report requirement is a key aspect of this accountability. What does this report typically encompass?
The annual report provides a comprehensive overview of the board's activities, including monetary policy decisions, regulatory actions, and financial statements. It's a vital tool for public understanding of the board's work.
The Act also mentions the Office of the Controller of the Currency. How does this office relate to the board's functions?
The controller of the currency plays a crucial role in overseeing national banks, ensuring their safety and soundness. The board and the controller work together to maintain the stability of the financial system.
The Act details specific responsibilities, such as setting reserve requirements and overseeing open market operations. How do these powers contribute to the board's overall mandate?
Reserve requirements directly influence the money supply, a key tool for monetary policy. Open market operations allow the board to buy and sell government securities to manage interest rates and liquidity in the financial system.
The Act also mentions the Federal Advisory Council. What role does this council play in the board's decision-making process?
The council provides valuable input from the banking industry, offering insights into the practical implications of the board's policies. However, the board retains ultimate decision-making authority.
The Act also addresses the Federal Open Market Committee, FOMC. How does the FOMC interact with the Board of Governors?
The FOMC, responsible for open market operations, is closely linked to the board. The board's chairman also chairs the FOMC, ensuring coordination between the two bodies.
The Federal Reserve Act, including Section 10, has undergone numerous amendments over the years. What are some of the key changes that have shaped the board's role?
Amendments have reflected evolving economic conditions and challenges. For example, the creation of the vice chairman for supervision reflects the increased focus on financial regulation following the 2008 financial crisis.
The inclusion of notes about amendments and their effective dates highlights the dynamic nature of the legislation. Why is it important to understand this historical context?
Understanding the amendments provides context for the board's current structure and responsibilities. It shows how the board's role has adapted to changing circumstances.
The Act's references to previous iterations of the board's name, from the Federal Reserve Board to the Board of Governors, also reflect this evolution. What does this tell us?
It demonstrates the ongoing refinement of the Federal Reserve System's structure and governance. The changes in name reflect broader changes in the system's role and responsibilities.
In today's complex global economy, what are some of the key challenges facing the Board of Governors?
Balancing economic growth with price stability remains a central challenge. The board must also navigate geopolitical risks, technological disruptions, and evolving financial markets.
How does the board's composition and structure contribute to its ability to address these challenges?
The board's diverse expertise and long-term perspective are crucial assets in navigating these complex issues. Its independence from political pressures allows for objective decision-making.
The Act's emphasis on transparency and accountability is more important than ever in the digital age. How does the board maintain public trust?
Open communication, clear explanations of policy decisions, and active engagement with the public are essential for maintaining public trust. The board's commitment to transparency is vital.
What are some of the key areas where the board might need to adapt its approach in the coming years?
The increasing role of technology in finance, the growing importance of climate change considerations, and the need for effective international cooperation will require ongoing adaptation and innovation.
That was a great discussion. Thank you for shedding light on the intricacies of Section 10 and the vital role of the Board of Governors in shaping our nation's economic landscape.